What are the main takeaways from the Federal Reserve decision earlier today?
Huge decision. This was a really big meeting, as we were expecting the Fed to raise rates by about 25 basis points, and they did do that. So you now have the upper target range for the Federal Reserve here in the U.S. now up to about 250. Now, it was really the forward guidance that analysts were really looking at for today. The Fed has now lowered their expectation for 2019 to 2 rate hikes from 3. And that is what we talk about with a dovish hike. Exactly what that means is we've sort of lowered expectations according to the dot plots. 5 members on the Federal Reserve have now come out and said that they see 2 or fewer rate hikes. So now really only 11 out of those 17 members are looking at 2 rate hikes or fewer in 2019. The Fed also added some language to their statement, which has been moving markets here a lot. They said that the word some gradual rate increases, and that word some was added, and that was a little bit dovish, but perhaps not as dovish as some market participants had really wanted. So adding that word was crucial here. And then also the Federal Reserve said they continue to monitor both global economic and financial markets, and that financial market statement is interesting given all the volatility in all the major equity indices that we've had lately. And finally, just wrapping it up here, another key thing that the Fed talked about was inflation expectations. So now looking at inflation that's about 0.1% lower than what they saw in September. So for 2019, now seeing inflation really only at 1.9%.
So how are the equity and bond markets actually reacting?
You've had a lot of move. So in the equity markets, it was interesting. When we came in this morning, we were a lot higher on the day. Originally, when the statement came out, we fell. We were fluctuating between gains and losses, and now we are all very much significantly lower. Every major index is off about 1%. Now, interestingly enough, we spoke with Jeff Rosenberg. He's the chief fixed income strategist over at BlackRock, which is the world's largest money manager. And what he said is that perhaps it wasn't dovish enough, and that the equity markets are concerned that the Fed is still going to be raising rates next year, and that's why you're seeing a little bit of a sell-off in equities, and that is going into bonds, and that is where a lot of the other bond markets are moving here. Originally, you had the 2-year yield rising, of course, as the Fed increases rates, but then you saw a big rally on the longer end, the 10-year and those 30-year maturities. On the 10-year, we're hovering right around a key level at about a 280, and the 30-year we're hovering around a key support level as well, right at that 3% mark. And one thing in the U.S. that we really look at, and that the Fed indeed does look at too, is that yield curve, and that's the spread between the longer and the shorter dated maturities, and that has been flattening. And the interesting thing about that is it's down to about 13 basis points on the 2-year versus the 10-year yield, and that's near the lows of the year. And if that inverts, it's usually a clear signal that there's a recession, and so something, of course, bond traders are watching today.
And then one of the biggest movers is GSK and Pfizer. They agreed to create a joint venture for their consumer health units. What are analysts saying about this?
Yeah, well, there are some individual movers that we're watching. It can't always just be about the Fed over here. And so, like you said, GlaxoSmithKline is one of them, and they've created a joint venture with Pfizer. These are 2 very big pharma companies, and what they've decided to do is sort of spin out their consumer health unit. Basically, GlaxoSmithKline was too small, and that consumer health unit, in order to compete with some of the other major players like Sanofi and Bayer, really needed to team up with Pfizer to be able to get some more negotiating power with advertisers and drugstores. And then that will allow GlaxoSmithKline to then focus on some of the pharmacy and the prescription pills and the prescription medicines here, which need to be a little bit more nimble and focus on innovation, and that will allow them to do that. And most analysts were very positive on the news. You had GlaxoSmithKline shares, those were up 2%. Pfizer was up as well, so most analysts treating this news as a positive here today for those stocks.
All right, thanks so much for that. Appreciate it. That was Bloomberg's Taylor Riggs in New York.